as a basis for financial analysis. So from the financial analysis, other parts would be extended at the planning and the decision making. All the decision making would be targeted on the future directions. So no one can take that as a past decision. All decisions are making for future performance. So that's why the planning is included in the decision making activity. So these are needed to predict, compare, and evaluate the firm performance, uh, which is defined in the two dimensions: the profitability and the financial position. So why do you want to do the analysis? To predict what will happen in the future, near future. Then the comparing between the 2 years or among many years, the past years, and to identify any improvement or decrease or increase in the performance level. Then they evaluate firm financial performance. So financial statement in itself may give you some idea about to conclude about the financial performance, profitability, and the financial position. So, an example, 1 million is reported as a net profit for a year 2022 by a firm. So we can judge only that the 1 million is a net profit only. So it will give very less information about to conclude about the profitability of the firm. So it should be do the evaluations, comparisons should be done. Suppose that the 2022 year profit, net profit 1 million is compared with the previous years, 2021. Say only 0.5 million was the net profit after that, the 2021. Now it has 22, it is observed as increase. 0.5 million has increased. So anyone can do say that the profitability has increased comparing between these years. So likewise can be compared with another firm in the similar industry. Say there are two firms, X and Y. X produces 5 million as a net profit after tax for a year, while the Y company is producing only the 2 million. So when you're comparing X and Y, you can conclude that the Y is the X is better than this Y. And also you can do the comparisons with the industry. So industry is defined as all the firms operating in a particular industry. Say if you take that the banking industry, so all the banks are listed under the banking industry category. So the normally the facilitator in the financial market, like a central bank or statistical department meeting, or that the stock exchanges may have the database about this industry. So they will record and work on the statistics of average performance of the industry every year. Suppose that if the banking industry's average net profit after tax is 2 million for the year 2022. So when one bank evaluate its performance, or any investors evaluate the performance of making the profit of the tax by comparing it with the industrial average. Suppose that the particular firm is producing 1.5 million, but the industry has produced 2 million. So at the time, it is easy for the analysts and the managers to conclude that the particular bank is performing lower than this the average performance in the industry. So likewise, the comparison and evaluations must be done. Otherwise, no action or decision making can be done without the pure data. So it can be extended to the financial position also. What do you mean by financial position? Profitability is different from the financial position. But it's a part of financial performance, one of the dimensions. Financial position is the nature of the assets and liabilities at a particular point of time, but the profitability for a period of time. So financial position also should indicate that the total financial performance. The firm should have the good the total assets and net working capital and the liquidity positions at a standard level. Uh, so, for an example, they should have this the working capital management properly by having this the current ratio 2.2:1. They should have the 2 rupees in the hand as money to pay off this 1 rupee of liabilities. Then only the firm could be judged as a good firm, as a good safeguard for against this liquidity problem. Then the composition between these the non-current assets and the current assets. Some firm would have the higher non-current assets while having the less working capital. So it depends on the nature of the business also, but mostly there should be a balance between the non-current asset and the working capital, because of the profitability would be affected by these kind of proportions. So all the funds are invested in the long-term assets, non-current assets. There will be less money for the working capital. At the time, the firm cannot operate efficiently for the day-to-day operations. At the time, they have a lot of money, lot of investment in the working capital. They lose the profitability. They can capture opportunities for making the performance generating revenue. So there should be a proper evaluation over it. It can be compared the previous years among the years and among the firm. So in the financial analysis, you can come to know that the terms in the literature, the books, how that uh, so a lot of the other efficiency operation also would be indicated by this to indicate the financial positions. So the overall and very specific aspects of financial performance would be evaluated so that decision making can be facilitated by managers. Otherwise, the firm would be operating as the illiterate people, like in that the rural area, they will be doing the business. But as far as the company is concerned, it is a well established organization. It should be very properly facilitated with kind of this the information systems. So they can't play with the games. Otherwise, they can't survive in the business. So these are required to aid in investing and financing decision making. So when you are looking at the decision making group, there are two type of decision making indicated: investing and the financing. Those are the main one. In addition to that, the other liquidity investments, liquidity decisions, and the dividend decisions are the other equivalent decision making area. But initially, this kind of the financing and the investment decision would come first. After doing this planning, investment planning, so the ways to raise the financial resources would be planned. So investment decision comes first and the financial decision comes second. Then the other functions would be continuing, that is the working capital management, working capital decisions, and that is called the liquidity decision. Once the firm is started to operate, the working capital management should be the main functions to be managed by the managers by taking the proper decision to run the organizations in the profitable way. And also some other decision and the investment and the dividend decision also should be taken by the managers at the end of the year to pay the dividend or retain the earnings so that they can reinvest the money to develop the businesses again. But the declaring the dividend paying, the dividend will have some sensitive impact on this the value of shares. So a lot of theories are there which I have studied that the behavior of this the shareholders and determining the value of the share they are holding. Even the dividend announcement will have this the impact of the shareholders. The share market operation would be affected by this kind of the dividend decision. For a particular company, that the value also would be having impact. That dividend decision is important for this the organization because for the future periods, the company, if the company wants to raise more capital from the capital market by issuing shares, so it should be in an attractive position when the company is issuing the initial issues. Then it should be bought by the existing shareholders or new shareholders, and they will look into that as the past history of this the firm in paying the dividends to them. They are happy about that. They will come to invest in the particular company. So that kind of information, the dividend decision is important for these managers. And this kind of financial analysis also will give the managers to keep it so the good dividend policies. So the financial analysis is very important, basic fundamentals That's why I have taken this subject as a first subject to understand the things from this perspective. Right. Then everyone, all are accounting learned students. So in the first year, you are given this the accounting, financial accounting. But the company accounting would have been uh, given in the second year, the second semester also, I think. Some other person will be giving you the lectures over this. But in the first year, we couldn't cover up this the full detail about how to prepare this the financial statement of a company, because of the just only two credits subject. Only the basic bookkeeping aspects were covered there. And it was introduced to you that this kind of financial statement of the big businesses, big firms like company or partnership in this. But it was deeply discussed because the credit is limited to do one. Earlier, we had a four credit subject in the financial accounting in the first year, where up to final account it was covered. Only the 3 hour final examination were conducted there. But later that it has been revised to have only two credits for financial accounting, the cost and cost accounting, cost related accounting, and the management related accounting basic in the second semester, in the first year. But the company account has been shifted to that the second year as an intermediary, the advanced account. Anyway, that you would have studied that as a financial statement of a company, the advanced level very deeply. So advanced level syllabus is a very quality syllabus when compared to that other syllabus contents included in a degree program, the comprehensive one. So you can recall the knowledge what you have learned earlier. The financial statement. The third year program also you would have you will have the chance to study a lot of things about this company accounts in the different subjects, auditing and the accounting standards, reporting standards. We can cover up a lot of issues there. Then the final year also you will have this the financial statement analysis, very comprehensive analysis. So I have taken this subject to introduce you the management of commerce students to have this the good basic knowledge about it, to do the review of this financial statement and how to do the financial analysis. So you can retain this knowledge until you complete your degree program. So a lot of application of this knowledge are there in the different other subjects also. I think it is the first time you are going to learn this financial statement and statement analysis in English medium. So you see that the component of the financial statement currently it has been required by this the accounting standard LKS 1 to publish general purpose financial statement. So these are the components. You can see the statement of profit or loss. Nowadays, it's called the statements of profit or loss and other comprehensive income statement. Statement of profit or loss and other so you can edit it, no? There are two components. Other comprehensive. Anyway, that we want to learn the contemporary updation of this the lessons, statement of other comprehensive income. So you can see the LK. I think you would have studied the advanced layer also this format. Earlier it was called the profit and loss account, income statement, total comprehensive income statement, something like that. Nowadays, you can see that it is internationally recognized uh, to use this word, especially with the companies. But it has been mentioned in the standard that it is not necessary to call your statement in this correct name. So you can have the synonyms for this statement. You can call it as income statement also. But there should be some recognitions for the company which totally complied with the standard in producing financial reports. Even the auditors also would recommend to keep that the terms stipulated by the standards. Otherwise, they can't approve it. So, statement of profit or loss and other comprehensive income is a current name. You can read. Then the statement of financial position, statement of changes in equity, statement of cash flows. So you can't call the cash flow statement. It's called a statement of cash flows. Cash flows, cash separate, flows separate. And other reports, other explanatory notes are there. So five sets of financial statements are included in the financial statement of a company. Right. First, you must understand this one. Then you can go for the some basic aspects of this, the purpose and the outcome of this kind of statement. So we want to review it. You can think that we have learned all these things earlier, that, but anyway, that your knowledge should be updated every time. It reports the results of operations for a period of time. So the main feature is that the statement is prepared to report the profit earned throughout the period, defined period. So it is called the period of income. So the results of operation is a term used in the literature about that. Is this a profit or loss? So the result of operation may be profit or loss. Operations means activity, business activities, buying and selling activities or production activities, exporting, importing activities, something like that, all are operations. So it should be measured using these statements of profit or loss for a period of time. The period of time, earlier it was called as the financial year. Now it has been mentioned that it is not a financial year. It should be defined as a period of time. Because a lot of companies may vary in the defining this year, financial year. They can, if the general meaning of a year is 12 calendar months, 12 calendar months. But it cannot be expected that every firm should follow that kind of the 12 months report. Because sometimes some businesses may exceed the 12 months period for complete your business cycle, operating cycle. It's called the operating cycle. Operating cycle means that they start buying the raw material for production, then producing the production process, then converting into the finished goods, then the distribution of the finished goods to the wholesalers, and then it will go to the hands of these retailers, finally the consumers, then the credit collections could be collected. Again, the cash will be coming in their hand, and they start purchasing the material again. So this is called the operating cycle. So this operating cycle may exceed that the 12-month period for some companies because of the nature of these businesses. It will take some of the production time, processing time very much. In some other businesses, very quickly, the bakery is daily. Operating cycle is a day. So in the night you can put the mixture of flour, and the following day you can produce foods, the breads, and realize within a day. Then the next day you start the process. But for big companies like producing in the car, uh, any other machines, so it will be taking a lot of time to producing the spare parts and assemblings and quality testing and everything. So it will be taking. So it is not nice that to define that should be the common period for all firms. That's why it's called the period of time. Commercial period of. So the maximum period is defined as 18 months, 1.5 year, minimum 6 months. Averagely 12 months period. Then you know that what is a profit or loss? You can't call it a profit and loss. Profit and loss. That's a wrong term nowadays. You can't use it. Because at the same time you can't report as profit and loss. It's net profit. So loss item may be reported, profit item may be reported. But net result should be either profit or loss. That's why you want to call it as a profit or loss. So the revenue minus cost, the basic component in the determining that as a profit or loss, revenue minus cost. When the revenue is more than the cost, you can result in profit. Cost is more than the revenue loss. This is general knowledge, everyone will understand. So where does the revenue comes from for the business? From the sales. Not, you can't claim it is from the production. After it is sold, all the goods are sold to the customers, so it will be recognized as a sales. So it is not look into that whether the sales are collected immediately. The sales are collected and the cash are collected immediately on the sales. It's called the cash sales. If it is delayed for a week or a month, so it is called the credit sales. But there's no guarantee that the credit sales would be collected from the customers. So based on the trust, it would be the sold to them and the customers see maintained. So there's no legal protections for this kind of the credit sales. So when sales are not collected to some extent, it would be recognized as a bad debt. So legal action cannot be taken against the customers to recover the bad debt from them, because in the by the law of contract it's implied that the firm selling this product on the credit is taking full responsibility. There's no written agreement, implied agreement or written agreement that the buyer, the customer should pay off all these things unless the person is agreed upon any bills of exchange. That's why some firms, when they sell the goods on credit, they can go for this some the agreement, payment agreement. It's called the promissory notes. That is the dues on that the sales would be paid on time, defined there. So if they deny or if they fail to pay that obligations, then they will be sued. The firm can take the legal against them. So value of sales is included the revenue. So the revenue is a common word used here because you can't recognize the finance institution like banks are doing this the selling business. Actually, they are not sell goods, so they are getting that the primary income from this in the interest on the loans they are providing. Uh, Insurance company they are getting these premiums from the policy holders as a revenue. Only that the trading companies or trading firms are doing these sales of goods and getting defined as sales. So the revenue is a common term. Costs. Why do you want to pronounce it the cost? Why can't you what is that? It should be the expense. So there's a difference between the expense and the cost. Slight difference in the meaning concept, meaning that cost would have the value. It is not still in some form, tangible or tangible form. Say if you want to buy a motor vehicle, if you buy a motor vehicle, you can say it is the cost of purchasing the motor vehicle because only the cash has been converted into motorcycle. So motorcycle is not consumed yet by you. Visibly is there. That sense it should be cost. Expenses and also the motorcycle would be useful for a long time. The cost would be remaining stable for a long time. It's not exhausted yet. But expenses in a sense that it is immediately consumed. Take one example, rent, house rent. If you pay the house rent, for what? Why do you use the house? So when you are renting out a house for the living, you are already used that, consumed the services. Now you are compensating, paying that. So you can't recover it. Hmm. So it is happened, occurred. So in that sense, you can call it as a expense, right? Anyway, here it is in the corporate finance topic, not accounting topic. We define the everything is the cost. Cost of sale is there. That is the total value of the productions or purchase done by a firm for a period of time, plus other operating cost, plus other operating cost. What do you mean by other operating cost? Why do you want to differentiate other cost into cost of sales and the other operating cost? Right. So when you are looking at the functions of a firm, production firm, factory, so they are mainly producing the goods. When the goods are produced, they will incur some cost expenses, raw material, paying the labor costs, machinery depreciations, rent, and factory manager salaries. All are accumulated as a cost of productions, cost of production. Then the cost of production is adjusted with the opening stock and the closing stock. It becomes as the cost of sales. But after doing this, the cost of productions, there are some other costs which are not included in the cost of sales. What are the administrative cost, general administrative cost. The factory administration cost would be added in the cost of sales. But other costs, indirect, like manager and the general manager salary, directors remuneration, office vehicle maintenance, something like that. Some other administrative. It is called establishment and administrative cost may be coming. Then another category is called selling cost. So cost of sales would include up to the cost of the production and adjusted with the opening and the closing stock in the finished goods. But when the goods produced are marketed, a lot of other expenses would be incurring. That is called the selling cost, selling and distribution cost. They become as a part of other operating cost. Then one more thing is that the finance cost. Finance cost also is included. Because when you want to operate a business, the plant, you want to have the money. So you can use your equity money plus the borrowed money. So borrowed money would be compensated immediately. They can't wait until you will earn the profit. So it should be agreed that you want to pay the interest. Say if you take a bank loan, the bank will require you to pay the interest on time, monthly basis, or quarterly basis, or annual basis. So it is a must obligation. So it is not involved directly in the cost of sales. So it is taken into the operating cost. So in addition to that, some other cost tax also may take place. There are two types of tax: the tax on sales and the tax on the income, profit. So usually it would be adjusted to the VAT with the cost of sales. So it cannot take into that the operating cost. It should be coming into the cost of sale adjustments. But the income tax, company tax or income tax may be treated as a part of operating cost. So in some cases, it can be recognized as an distribution of the income to the company, to the government. But nowadays, you can see that it has been generally recognized that it should be reported in the statement of profit or loss as a part of operating uh, cost. And in the sense it's there, but categorically it is mentioned as tax paid. Tax paid. So after presenting that the total and the other operating cost, in the other row, it is specifically mentioned that this is a tax paid. But why going to treat it as is that as a part of operating cost. That's why you want to get the net profit after tax as the performance indicator for the profitability. Some people may take that as the profit before tax as the good indicator for this profitability. But nowadays it has been dropped, that kind of general opinion. Profit after tax is must because all the companies, the firm should pay tax. So the tax rate also would be common for all companies. So it may be that the progressive rate or the flat rate when the tax policy is implemented. So other operating costs also included in the total cost. So I already told you that the cost of sales include the cost of production. Suppose that the company is not producing product but buying the product from outside and doing the sales. So at the time it should be recognized as a pure trading company. They are buying finished goods and selling the goods. So in case of this, the purchases, you can put it as a cost of productions or something like that. So there should be an opening stock and the closing stock. This is finished goods. Cost of production would have adjusted that the what do you call the opening raw material, closing raw material, opening work in progress, and the closing work in progress. They would have adjusted. Final result would be the cost of production. So even after that, some stocks are there. The opening and the closing. Why do I have this opening and the closing stock? Why can't you take all this total? This is because of this, the dividing the total operation into periods. So in accounting, all this data are taken from this financial accounting system. In accounting, there's a policy, accounting policy to be adapted by the firm. It's as going concern. going concern concept is to be applied, implied, reporting that. So their continuous operation should be broken into that as the periods, operating cycle periods. So when they have start the new the start the financial period, operating period, they will start with that the remaining the unsold goods produced in the previous years, previous periods. Right, when they are when they break the particular period operations at the end, so they will have some unsold goods, unsold goods that should be taken. So opening and the close, opening and closing would be coming to the any companies which is considered as a going concern. Concern means firm, organization. So there are some businesses which cannot be treated as a going concern. So they are called joint venture, very short term venture. They don't have the periods. So they can do the businesses for a very short period. And at the end of the period, they calculate the profit and share the profit and close the business. Again, after some interval, they can start as a new business. So at the time, they don't have the assets. Them. If they have the assets, also they can dispose. Say they have any tools to do the operation, business operation, they can dispose or assume to be disposed or taken by that the joint venturers, and they will do the accounting that way so that the net residual profit is there, so they can share it and earn it. So at the time, the opening and closing stock won't be coming. So normally you are going to learn this as the corporate finance for a big firms continuing the business for a long time. So then you can understand the gross profit. Everyone knows that the gross profit is a difference between the sales and the cost of sales, provided that cost of sale is less than the sales. Otherwise, it would be gross loss. Gross loss. You can also pay attention on that the concept of gross loss. Why do you want to calculate the gross profit first? So this is the major element of this indicator of this operating performance. Operating performance. The efficiency of our operation would be evaluated using this figure, gross profit or loss. And also it would be converted into the percentage. Say 25% of gross profit they have earned. Which indicate the efficiency. The firm in the producing the good profit at the higher margin. When you compare that the two firms which have this the gross margin, gross profit margin, there's 30%, other firm 20%. So you can easily judge that the firm having this 30% gross margin would be more efficient than the firm having this 20%. So you can wonder that they have earned a lot of uh, that margin, higher margin unlawfully. They are doing the legal business. So some even the customers' point of view, they will judge that the firm keeping their gross margin at low level would be benefiting to the customers, because in the low level margin they are providing the services to the customer. If you find any firm having this 120, 22, and 200% of the margin, and everyone will feel that. So this company is earning a very lucrative gains from the robbed from the customers. They buy the goods for the 100 rupees and sell for 200 rupees and earning 100 rupees a day. 100% profit. So it is seems that unethical. So the gross profit margin will have some sensitive indicator. But here in the literature, it has been recognized that it cannot indicate such kind of illegal things. Usually, the firms would be operating in a competitive environment, the competitive, perfect competitive market, where most of the firms are operating in that. Where that the firm which can deliver the goods at lower selling price would become as a market leader and more competitive than other firms. So to keep that selling price low, what they can do, they want to sacrifice their profit margin, or they want to reduce the cost of sales by reducing the cost of productions, unit cost of production. Yeah. So the firm, suppose that the selling price is the market price. Every firm is selling the same price. So no need for the firm to reduce the selling price. But it's in a high margin. How they are keeping reducing the cost, unit cost of production. They can reduce the unit cost of production. They can earn a good profit margin, keeping the same market selling price. So at the time, it can indicate that the company is operating efficiently. The firm. So this kind of information is presented in the financial statement of profit or loss as the initial part, gross profit, so that the analysis or investors can judge that the percentage, etc. Then only other net profit is presented. So you know that net profit is extension of gross profit. Other operating income and operating costs should be deducted. So what do you mean by other operating income? So the main operation is producing the particular product and selling it. But some companies may be earning some other sources of income. This is called other operating income. Suppose that the firm has some excess cash and invested some money in the government bonds. government bonds and the treasury bills. They are earning that the interest from the bond periodic coupon payments. So such income should be treated as an operating income. There are some other classification of the other operating income into operating income and the non-operating income. Based on this, the guidelines given by the accounting standard and the theory, such things can be decided. Discount received. What do you mean by discount received? So it is common in the normal trading businesses that when the payment to the customers and the suppliers is paid immediately, they will provide some discount on the total dues. That is, the early payment will result in some benefits to the company. Such benefits should be accounted here as a part of operating income. Discount receipts. Rent received also you can get it. If you are building a motor vehicle, when they are put into hire, so the rental can be taken as a part of operating part. What is the non-operating? Non-operating is like the interest from investments in other companies. Why do you call this non-operating? Because the main operation is the producing goods selected and selling. So in addition to that, some incomes are coming in the other sources, which are not connected mainly to the operation. They call this non-operating. And also other criteria also can be applied to the recognize this one as non-operating. The infrequent frequency. The overtime is arising once in a time, not regularly. Then you can take it as a non-operating. Then the operating cost is a common, as I said earlier, selling and distribution, and establishment administration, finance cost, tax also make interest. Finance cost also will become. So general understanding about this, the financial information presented by the statement of profit or loss. Nowadays you can under that some additional things. Other comprehensive income. What do you mean by other comprehensive income? So a lot of the big firms are operating in the multiple businesses. They can target some of the exports markets, foreign markets. So when they are doing this at the foreign exports, they will doing all the currency, foreign currency conversions. So some chances are there for the opportunities are there for the companies to earn some gains or losses on this other translation, foreign translation currency loss, gain or loss. Say nowadays the dollars. Now Sri Lanka rupees are appreciating against the dollars. So those who have called the held that the dollars earlier, purchased in the high prices, paying that now they can't sell the higher price. They want to earn loss now. Loss, likewise, such kind of earnings are or losses are arising. That are put into the other comprehensive income. It's separately disclosed. Then some other items, very specific items. The financial market, they will do some operations with these are the financial derivatives and hedges, insurance type hedges. So in that the transaction they will face some losses or gains that should be reported. Then the other revaluations. Revaluation gains or losses also may be reported as part of other comprehensive income. They are collectively called the dirty surpluses. So we don't have to do more analysis with that other comprehensive income. So normally the analysis are interested primarily on this the operating performance analysis. So we can eliminate that one also. So additional note is given regarding the composition of operating costs. Administrative cost, selling and distribution cost, finance cost, and other cost. Other cost means it cannot be categorized under this title. Selling, establish an administration. So in the financial accounting, we call it establishment administration cost. So here we can commonly mean that administrative cost. Then the selling and that's a traditional word establishment. Selling and distribution, there are two terms, selling and distribution. What is the difference between selling and distribution? Selling, packaging. Packaging can be a part of selling expenses. Distribution, delivery charge. The motor vehicle is used to transport the finished goods to the outlets, retail outlets. Then it's called the motor vehicle charges will be a distribution cost. The finance cost is interest. So you can wonder why can't you call it interest cost? Because finance related cost. Interest is one of the part of this the finance cost. Some other cost of the bank charges. Example. How do you call that the bank charges of finance interest? Can you include the bank charges in the selling and distribution or administration? So definitely you must put it into the finance related cost. So transaction they are charging the bank charges. So some other cost. What are the other costs? Some losses, fire loss. The firm, some goods destroyed by fire. So loss is calculated. Where can you accommodate? The administrative cost, selling and that cost. One thing. So definitely you put that collectively as a sundry other cost. You can't have every classification. Hundreds of classification. This is a tradition that you must have this operating cost classification. Then the net profit after tax. is coming. What do you mean net profit after tax? Net profit before tax minus tax. Why do you want to take this as the tax? Because the companies are tax liable. Why? Because according to the tax system and the act, the law, company is considered as a person, body of persons, like one man. So the profit earned by the company is like that the income earned by an individual person, household. So that's why they want to pay that as the income tax. So it is a direct tax. Otherwise, the legal system will seize that the company and close. So any business organization registered as a company should pay tax. Even the private or public or partnership business. But even the partnership business, it's not a company. Registered under the company, but operating as a partners. Private ownership. So a special bill, the unlimited liability, one party, even liability limited. Company for the company, liabilities are limited. For the partnership, to some extent, it's unlimited. Meaning that if a loss is occurring beyond the capital contributed, they want to lose their own asset also to pay off the dues to the other stakeholders. That is one of the main features differentiating company on partnership. At least one partner should be there. Actually, the partnership business is not paying tax. They don't show is the financial statements. They normally the partnership business are not publishing these the financial reports. They are preparing the financial report for their own purpose, not for the publication purpose. So no one can get access to that. But in the financial statement supposed to be accessing by you, you can observe that the tax component was not there. Because the partners would pay the tax, individual partners, as from their own income from the business. As from their own income from the business, in the partnership. So normally the partnership after calculating net profit, so it would be distributed. That is the interest on capital and the partner salaries, commission, everything would be distributed first. Then some profit would be residual. That would be shared by their according to the agreement, profit sharing ratio, and it would be credited to their capital, and they can reinvest or consume it as drawing. But they want to declare it. They are earning this profit from the partnership. and tax department will calculate the profit they want to pay individual. So at the time, the net profit after tax won't be coming to that kind of partnership business. So we don't have to look into that part. Then taxation. Taxations may differ based on the volume of the profit produced by the companies. Maybe the flat rate, same rate for all companies, or whatever amount. Or it could be the progressive one. Nowadays, the progressive ones are there. There should be some upper or lower limit of profit they can produce against which the percentage is determined. Right. So according to the current format, net profit after tax is a final element included there. Then what do you mean by retained profit? This component is not presented yet nowadays. So net profit after tax will be reported in the statement of profit or loss and other comprehensive income separately. Retained profit, you can't find any separate things. But the statement of changes in equity, you can find the one component, one column with the title accumulated profit of the profit or loss account balance. Where the opening balances would be there. Then the profit, net profit after tax when during the year would be reported. Then the other comprehensive income item would be reported. And then finally, the closing balance would be carried forward. And it would be shown in the statement of financial position as a balance of this profit or loss or retained profit. Dividend. So you know that except this preference dividend, ordinary dividend. The ordinary dividend means the dividend being payable to ordinary shareholders, they are declared. The shareholders meeting. It is not guaranteed. So according to the current accounting standards, the dividend cannot be shown in the statement of profit or loss or statement of changes in equity as a dividend payable. It should be shown as the note form, additional note form as a dividend declared or dividend proposed or something like that. So there's no obligation for any company to pay the dividend. It cannot be recognized as a current liability. But dividend for the redeemable preference or preference that is liable. Company is liable to pay it because it is agreed. It cannot be considered as an equity instruments, only the loan instruments. Preference capital. Know that the retained profit, net profit after tax minus preference dividend can be taken. So a lot of the retained profit for that period, then the retained period balance would be there. When you are adding with the opening one, then the final balances would be carried forward with the name retained profit. accumulated one. There are two versions: retained profit for the period, retained profit carried forward from the past period. Right. Next thing you want to understand the component of the statement of financial position. I skipped this the statement of changes in equity because uh, there's nothing uh, the component to be taken into analysis. We have just looked into that statement of financial position. It shows that the financial position of the firm at a point of time, usually as at the end of the operating cycle or the year, maybe at the end of December, commonly. Financial position is represented by assets and liabilities. The liabilities equal to equity plus external liability. So this is there are some items to be disclosed by this the statement of financial position as per the LKS 1 minimum elements. All are coming under these categories. Equity should be external liabilities, current liabilities, long-term liabilities, assets, current assets, all the breakdown are there. But you must understand some the term used here. Liability uh, is defined as equivalent to the asset, total assets. So it will be including the equity plus external liabilities. Meaning that the equity also part of liabilities. Even though the company is owned by the equity holders, the company itself is liable to pay off this dues to the equity holders at the end. Who will be paying? The equity holders themselves, they share it. So in that sense, you can call it as a part of liabilities. So no one can argue that it's a equity ownership and other things are liabilities. No, that's wrong concept. So in addition to the equity, you can term other things as external liabilities. The internal things is that the owners are contributing. External liabilities, other parties like the financial institutions and the creditors are supplying these funds. But they are not part of this internal management operation of these companies. They are outsiders. That's why you can call it the external liability. Equity, internal. Because all the young holders are the part of the owners. You can't call only the board of directors as the owner of this. Board of directors is an administrative body hired by these the owners, that is the shareholders, equity holders. So liabilities, and in a sense, you mean that they equal to the total assets. Then what is how can you define the equity? There are two components, common components. Ordinary share capital, which is share initial capital plus reserves. plus reserves. So it is required by the standard that the initial capital to be stated separately, and then additional reserves should be stated separately. You can't mix up. So in the earlier practice was that the Shah capital should be given a lot of details about that. How much the authorized capital, authorized number of shares, the nominal value, par value of the shares, then how much the issued capital, how much the subscribed capital, the details should be there. Even in the facet of this, the statement of financial position, you can see it. Nowadays, you can't see it now, but the details are given in the explanatory notes about that. Reserves means that all other balances. Earlier, it was called categorized as capital reserves and the revenue reserves. Now it is commonly termed as reserves. Capital reserves, capital and any undistributable profit are termed as capital reserves. Distributable reserves are called revenue reserves. What do you mean by undistributable revenue reserves? So earlier it was reported as a Shah premium or capital redemption funds. So if the revenue, the profit reserved as for the purpose, long-term purpose, for the redemption purpose and liquidity purpose, then it can be called undistributable capital profit, capital reserves. Revenue reserves would include the retained profit, accumulated profit, any other dividend equalization funds, something like that. But nowadays you can't observe that kind of classification available in the statement of financial position. External liabilities should be defined as having this component, the long-term liabilities and the current liabilities mainly. So you must understand what is a long-term and the current. So standard has prescribed that the definition to be applied to define this current or long-term that way. Usually based on the timeline, current liability, the liabilities changing its values within an operating cycle or financial period, defined financial period, very short term. The current liabilities. Long term is more than that, beyond the operating cycle. A 5-year bank loan, so long term liability. Nowadays, you can observe that the long term part of long term liabilities, say for an example, loan. Loans are payable in installment periodically. So the part of the loan, portion of the loan currently payable within the next 1 year or next operating cycle, that should be taken into current liability portions. So one example is the 10% bank loan, 5 lakhs are there, the opening. So every year 1 lakh is being paid. So when you find that as a bank loan, under the long-term liability category, you can have this 4 lakhs, other 1 lakh under the current liability. So anyway, that you want to take the current liabilities separately, long-term liabilities separately, as reported the company annual report statement. You don't have to analyze it further. This is approved by the auditors. Even in the current liabilities, you can have the two classification: operating current liability, non-operating current liabilities. So that is the advanced features of this the liabilities analysis. So under LTL, long-term liabilities, LTLs mean long-term liabilities or long-term debt, LTD. Two components are there. Debentures. These are the long-term bonds. The corporate bonds are called debentures in American terms. Then the mortgage loans, long-term loans, bank loans, etc. Plus one thing is added here. It's very interesting point of why you want to add the privilege habital into loan. So it is a convention that the nature of this item, privilege habital, can you treat it as an capital or equity capital? It cannot, because the features, the characteristic of privilege capital have similar to that of characteristic of loan capital. Because preference capital, privilege shares are given some preference. They want to be paid dividend as interest. They have the no voting rights as equivalent to that equity holder, except some cases. They have the preference to get the dividend. Fixed dividend. What is the fixed dividend? Sometimes if it is not fixed, percentage should be fixed. The company is making losses and not in a position to pay it the dividend. At the time, legally it is said that should be accumulated. Dividend should be paid whenever the firm earns a much profit. So all the arrears should be paid later. Then there's a preference on the redemptions. When the company is liquidated, the privilege shareholders should be paid before the ordinary shareholders, after the debenture holders and everything. they want to paint, repair. So all these characteristics are similar to that of long term. That's why it is taken into the preference, the long term lab. Don't forget that. Then I want to summarize, finish it with the remaining things. Net worth. Actually, net worth is not presented in the financial statement, published financial statements. It's a market value equity. You want to have the additional information to calculate this net worth. Then asset side, you know that non-current assets and the current assets are classification. Working capital. Current assets minus current liability. Sometimes it can be called as a net working capital. You can't simply call the current asset equivalent to working capital. Remember that always the current liability will be deducted. So in some other cases, excess of current assets. Working capital means excess of current assets. Capital employed, another term used. So there are different versions of definition to indicate the capital employed. One of the definitions says that equity, pure equity is capital, or equity plus long-term debt. Meaning that you want to exclude the current liabilities. Current liability is not a capital employed. Meaning that it should be in a long-term nature. The LTL and the preference capital also will be added. So in the absence of long-term liability, you can get it as a equity. So if there's a presence of this long LTL, you want to take it as equal to the capital employed. So another definitions and versions are also reported in the literature that it is equivalent to the total capital, total assets. Meaning that at the end, the current liabilities also are a part of capital employed. So as the name indicated, the capital is should be in the long term. When you are differentiating working capital with the capital employed, it should be done necessarily because the working capital current liability is included. So unless otherwise it is specifically stated that you take that as a current liability as a part of capital employed, you want to take only the equity or equity plus long-term liability, including preference capital. Don't forget that. Right. So in the next schedule, we continue that the analysis part. Tomorrow you will have the tomorrow day after tomorrow. So Rep, encourage your participants to participate in the Zoom. Only 116 are participating. If they miss the lesson, they can't get a pass on this course. So without guidelines and everything, they can't get the correct answer for the questions. They may think that they can study self. Lot of complicated things are there, the other lessons to understand. So let them join